Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Adrian Ash runs the research desk at BullionVault, the world's largest online investment gold service. He's online at BullionVault.com, and he joins us today from London. Hey, Adrian, good to have you back on This Week in Money.
Thanks very much, Phil. It's great to be here.
Outgoing Bank of England Governor Sir Mervyn King at his final policy meeting today. Bank of England keeping its interest rate at 0.5% as Canada's Mark Carney, the George Clooney of central banking, takes over next month. He'll be the world's highest paid central banker for the trifling sum, Adrian, of £874,000 a year. He's going to save the UK economy, and we couldn't be happier.
Well, I mean, if he manages to do what needs to be done, then yes, he's going to earn every penny. But he's also got a huge housing allowance as well, over and above that. I forget what the number is, but
300,000, I think.
Yeah, that's right. That's right. But that's it's a good start as a governor at the Bank of England, because clearly he's got a vested interest in keeping house prices high, so he can spend more of that money that he's been given as a stipend there. And that's basically what governors at the Bank of England are for these days. He's trying to make sure that real estate prices are kept astronomically high, preferably with zero to nominally low interest rates, pumping money in wherever possible, particularly in the southeast. I mean, the rest of the country can go hang as far as most of London, the financial services sector could care. But so he's off to a good start already, and he hasn't begun yet.
Now, the guy's had a pretty good buzz, the rock star of central banking, et cetera, et cetera, et cetera. What kind of challenges does he face with the UK economy?
Well, I mean, he faces, it's a very different situation to what I think he's faced in Canada. I mean, if you look at, people are lining up to say, he can't work miracles. It's interesting, there was a little flurry of articles earlier last month saying, let's just remind ourselves that, the guy can't walk on water. And I'm sure that's not news to him. But Carney's going to go from a resource-rich economy with government debt forecast to start falling next year as a proportion of GDP, and he's going to have to go to basically funding a rising debt burden, with the banking system still on life support, the economy as a whole spending 4% more than it earns for the next 3 years running on the current account. So it's a very different ballgame that Mark Carney is going to inherit here. And I think, as ever, again, for a Bank of England governor, devaluation is going to be the standout policy choice. Again, it's interesting to see the little flurry of newspaper articles, pundits, think tanks, and so on lining up to say that, the first thing he should do is turn the screws even tighter on UK savers, look to devalue sterling to try and divvy up what little exporting economy we have. And I don't doubt that he will try to do that.
Looks at least like the Carneys, Adrian, picked the right football teams here. Last time we talked, Mark Carney said his favorite team was Everton, and Mrs. Carney picked Arsenal. They're number 6 and number 4. They
didn't do too badly. Yeah. I certainly did better than Mervyn King's team, Aston Villa, who we only just escaped being relegated, actually, from the Premier League this season. And that was really more by luck than our own skill. I'm a Villa fan as well. But, if he can do anything like that in terms of, throwing a dart at the dartboard of central bank policy when he starts next month, then, as I say, he might be earning some of that money he's making.
We'll keep an eye on Mr. Carney and see how he's doing at the Bank of England. Adrian Ash from BullionVault.com. On This Week in Money, elsewhere in Europe, ECB keeping its benchmark rate unchanged. Mario Draghi, the president, saying he'll be easing monetary policy in the near term, but he just doesn't know when.
Well, the big thing here is, you've still got this huge schism within the ECB. I mean, you've got to remember that the European Central Bank, these guys can't decide what to have for lunch. There's so many people in the room. It's even worse than a US Federal Reserve meeting in terms of, just how many policy wonks have got to sit around a huge table in Frankfurt. And the problem that you have is that it's basically, there's a huge schism now between Germany, who are sitting there with basically all the growth and all the money and all the discipline, and the rest of the Eurozone, the other 16 members, soon to be 17 when Latvia joins at the start of 2014, who would much rather have a kind of Bank of England style policy on this, which is, let's devalue our way to growth. That's the idea which obviously Italy used to play, Spain used to have exactly the same game plan as well, France. So Germany is really up against it now, and the Bundesbank's control of ECB policy, obviously the ECB sits in Frankfurt, that's pretty much where it is, and the ECB ideologically was always founded upon German discipline, stability, low inflation, strong interest rates when needed, etc. What you've got now, however, is that rather than inheriting the Deutschmark, the rest of Europe is kind of turning around and trying to inflict a little bit more Mediterranean-style policy perhaps on Germany. It's going to come to a head next week. What you've got next Wednesday, interestingly, far away from the central bank policy halls, is there's a court hearing in Germany. A group of Germans have taken the ECB to court, challenging one of Draghi's key policies, which he hasn't actually used yet, which is these outright monetary transactions, whereby he would support weaker government debt in the bond market. It's being challenged basically as a form of monetization, which is illegal under various EU treaties and so on. And the Bundesbank have actually submitted their opinion on this to the court. And of course, their opinion, the Bundesbank, is that, well, no, this shouldn't be allowed, and that the court challenge is exactly right, and that the ECB shouldn't be allowed to do this. So it's basically going to be, a star witness, and it's likely to lose. And this is going to be very embarrassing for the Bundesbank in terms of its credibility globally, but also I think within Germany in particular. I think it's likely to inflame a lot of anti-inflation, anti-euro opinion, and I think this, could be yet another step along the road to the deepening rift within the Eurozone.
The European Commission seems to be everywhere these days, Adrian. They are complaining today. They're going to propose putting a regulation of Libor under a European rather than a national umbrella. Tell us what Libor is and why they're trying to do this.
Well, I mean, Libor technically is the London interbank offer rate. So it's now London, we must remember, and we do remember it here, of course, very, very clearly every day, that we are not part of the Eurozone. This is another problem which is coming to the fore and is likely to come to a head in Europe over the next couple of years, that the UK, the largest financial centre in Europe by a long way, on a par with New York, ahead of Tokyo, etc., in terms of currency flows, in terms of derivatives trade and so on, London is the world leader. And we're not in the Eurozone, don't wish to be in the Eurozone. No government in their right mind would suggest to the UK population that we should join the Eurozone. But the problem becomes where the Eurozone, needing to sort out its own problems, has to start looking at the other aspects of monetary policy which they've neglected to put together when they built the single currency a decade and a half ago. Things like banking oversight, things like control of government deficits and so on. I mean, you have a sovereign currency here without a sovereign. So there's all these things that the Eurozone still needs to sort out, and banking resolution is one of them. And obviously regulation. Brussels is a big fan of regulation. It's basically what Brussels does. They believe in regulation. They believe that policymakers can fix things better than free markets. It's gratifying to think that here in the UK, most people I think tend to think the other way. But yes, so the London interbank offer rate is basically the way that banks quote interest rates to each other for overnight money, whether that's to get each other out of a hole short term or just to keep the wheels greased and turning. To have oversight of that from Brussels is going to be very odd. There's other things as well going on as well, of course, like a Tobin tax, literally a financial transactions tax. An awful lot of business will simply go to Asia. Long term, I think, listeners to your show are going to know that that's pretty much where the economy is headed anyway. It's certainly where the gold and silver are moving longer term. And the European Union would like to accelerate that, it seems, by regulating financial services more tightly, and really by missing the point. The point here is when you have financial services running amok as they have done, my view is it's more as a result of government support, government ring fencing, divvying up their own domestic banks at the expense of free competition, rather than a lack of regulation. I mean, that's really what I think led to the financial crisis as we saw it 5 and 6 years ago. Europe got upside down yet again, and as I say, I think the bigger risk, particularly for the UK, the City of London will fight this very hard, and I think that the more that Europe pushes on regulation, the more it will actually push the UK out of Europe, full stop. And there is a growing groundswell here now. It's no longer a swivel-eyed kind of minority view that Britain would be far better off outside the European Union. At the moment, I'm kind of equivocal on that, but I think the more that Europe regulates, over-regulates, and looks to shut things down in that kind of fashion, absolutely right, we should be out.
Adrian Ash, on This Week in Money, we are always thinking about the Fed. It's just like Jaws. It's always there in the background. You're writing a couple of great pieces this week on the Fed. Why the Fed can't end QE, and QE, ZERP, and the zombies. Tell us what's going on here.
Well, I mean, the problem that the Fed have now, and I'd say it's the same for the Bank of England. I'd say it's pretty much true for the European Central Bank as well, and it's most definitely true for the Bank of Japan, although they're going the other way as fast as they can. I mean, this kind of kamikaze attack on their own currency. Once you've gone to zero interest rates and money printing, how do you turn that around? I mean, to look at the U.S. economy and to say that it's recovering. Obviously, this week we get the non-farm payrolls report for May. a typical noise and fury event for the gold market, along with currencies as well, which typically leaves you no wiser at the end of it. But is the economy gaining enough traction? Is it gaining what Mark Carney has called escape velocity to start moving away from the extraordinary accommodation, as central bankers would call it? The rest of us would just call it money printing. Have we got there yet? Well, we haven't got there without these things. We haven't got there without zero interest rates, and we haven't got there without allowing companies which should have gone to the wall, debtors who should have defaulted, creditors who should have been wiped out. We haven't got there yet without those guys being kept on life support. So at what point do you turn the life support off? If the patient is still alive and he's got a heartbeat, but simply because he's hooked up, then dare you turn the machine off? I think we've seen the stock market give Ben Bernanke a warning over the last week and more now. Obviously, the crash in Japan after its phenomenal rise on the yen devaluation starting in November, that I think has got a lot to do with the skittishness that stock market investors globally have suddenly rediscovered. But also the idea, which the Fed have been quite happy to talk up, that, at some point we're going to, remove some of this accommodation, maybe move the guy out of intensive care and put him back on just the serious ward. Stock market has said, no, you can't do this. We need this money to maintain where we are. And even the merest hint of withdrawing this. I also think that gold has obviously been an outlier on this, gold and silver, and an early heads up on that from what's happened to them so far this year. Silver's off 25%, gold's off 17% 2013 to date. Two reasons there. Obviously, the stock market has been performing very well, and you wouldn't expect your insurance to pay out when everything else is going fine, which is what's been happening for equity investors on a nominal basis. But also, the idea that actually interest rates might one day go up from zero. Well, it's really the direction of interest rates. I know we discussed this last time I was on, Phil. It's the direction of real interest rates. What do you get in cash in the bank after you account for inflation? It's the direction of that number that really matters for gold and silver prices. And certainly you've seen on 10-year yields and US Treasuries, they have been ticking higher. US savers are pretty much at break even. Woohoo! If they put money into treasuries right now, they can lend to the government for pretty much free after inflation. But that makes a change from a couple of years ago, where you got to the worst negative real interest rates in 3 decades. So there's a couple of things going on as a result of what the Fed have been muttering about. I still think, as I say, the stock market is trying to call their bluff. And I don't think they're going to do it any time this side of 2015, which is the date they've already put out there. But it's going to be interesting to see. I mean, David Galland was on last week from Casey saying, the Fed is absolutely integral to how the bond market works. And, we're getting little warning signs that actually you can't pull away from this stuff once you've put it into place.
Adrian Ash from BullionVault.com, our guest here on This Week in Money. Let's talk about gold and silver. We were talking earlier about them holding above $1,400 an ounce today. A fascinating story today out of India about gold demand. What's the government doing there, and what's the ramifications here?
The problem that the Indian government have identified, and they've been banging on about this now for about 18 months, is that India has a horrible trade deficit. Its current account deficit is big and rising, and because India is such a huge importer of gold, it has no domestic mine output of its own, but it is the world's #1 consumer market for physical bullion. So it imports an awful lot of gold, about 900 tons last year, even more than China, and continually more than China, even though China has come up so fast on the inside rail. So the government have decided, starting round about January 2012, that they need to start clamping down on demand for gold. All they've managed to date, of course, is to clamp down on supply. And even that they haven't managed, to be blunt, because we know that imports of gold into India in May came in at about 160 tons, which was pretty much twice the monthly average of 2011, which was a record year for gold. So, they've succeeded in neither cramping demand nor supply so far. They've got very, very serious about that this week. So on Monday, the government, the Reserve Bank of India, first said, right, any gold imports coming in now have to be fully cash paid. They can't be done on a credit basis unless they are explicitly going to be re-exported by jewelry manufacturers. So that pretty much shuts down an awful lot of the money flow in the gold bullion import business into India. And that didn't do a great deal. Knocked about $8 off the price on Monday and then came straight back up. Nobody noticed, nobody cares. So on Wednesday, they then said, okay, we're going to raise the import duty. Now, they started doing this back in early 2012. At the time, it was worth about 1% by value of gold imports. It's now going to be 8% by value. They raised it this week from 6 to 8% by value. That's a pretty high number. Now, you're really getting to the pinch point now where, because Indian demand is not going to go away, I mean, this is the bottom line with India. The deep cultural love, deep cultural associations with gold as wedding gifts, as an auspicious investment at all kinds of cultural festivities, religious festivities on the Hindu calendar. It's just not going to go away simply because the government says, oh, please, can you not do this anymore? So how else is gold going to come in? Well, there's a euphemism for gold analysts known as the parallel market, which basically means under cover of night, under cover of darkness, gold comes in from Dubai. That was how gold used to get into India before its market was deregulated in the early 1990s. Estimates that I've seen today come in at around maybe 20% of Indian gold imports this year are likely to be smuggled anyway, but with import duty at 8% and with the clampdown on credit terms now, you're looking at the illegal market clearly being given a green light. The anxiety from the Indian government, I think, is fair enough. I mean, it's, gold comes in, currency goes overseas, and they're left with a weakening currency as a result. Of course, like any government who faces this problem, the number one reason people are buying so much gold, the number one reason that people continue to buy so much gold over and above the cultural associations is that cash in the bank, regular savings, domestic investment isn't being well rewarded. Inflation rates in India are regularly in the high single digits. Interest rates continue to lag that. And as with most other people, if you lose money putting cash in the bank on deposit, you're likely to start turning towards hard assets. And that's particularly the case in India. It's, just like we had in the UK in the 70s, it's like the US had as well. If you won't defend the currency with strong real interest rates, people will turn to other stores of wealth, hard assets, particularly gold and silver. And the government response is typically that, well, okay, we'll try and stop you doing that then.
Great idea. On paper.
If only it would work.
Yeah. Adrian Ash from BullionVault.com here on This Week in Money. And you got a couple of interesting posts on the BullionVault.com website this week. One being from our old buddy Mark Faber. Cheerful thoughts from Mark Faber.
Yeah, always cheerful with Mark Faber. I mean, in terms of speculation, in terms of, trying to ride the insanity of what central bankers have done over the last few years, I think Mark Faber has made a very amusing and accurate forecaster on that. Short term, stocks in emerging markets, there are, I think, he basically says there are, some great opportunities there if you're picking and choosing. But the ongoing problem remains the abject monetary policy from Western policymakers in particular, and the bubbles that they continue to create. It's where do you put your money, which is a sensible investment where you're going to be rewarded for actual growth rather than just some kind of monetary speculation.
Now, even with all this financial stupidity going on, you think that would be driving gold and silver prices through the roof. We know that's not been happening. Where are we going from here?
We're going into the summer now. I know David Morgan was on your show last week, Phil, and said, a summer lull is pretty likely, barring some kind of crisis event. It's interesting to see gold holding up around 1,400. I mean, I think, it's been up and over 1,400 and back down again, kind of 6 days running now. It's looking to be a key level. Chances are when it makes its move either way, it's going to go very quickly. And everyone who's looking at 1,425 or 1,380 as the next level is probably going to be surprised, I would say. Summer is typically quiet for gold anyway. We do now have the extra drag short term on Indian gold demand because of the latest moves from the government. That's pretty likely, I think, to exacerbate any kind of summer lull that we do get. But there is clearly a lot of latent demand out there, sub 1,400, both from Asian physical buyers and I think increasingly from Western money managers who are reconsidering the shorts as well as the exit that they've had from gold over the last few months. So, all of the things being equal, maybe we can all take the summer off and come back 1st of September and get one of those nice autumn rallies in gold that we were so used to over the last 10 years. None of the problems that we've had over the last 5-6 years have really been addressed and fixed. Quantitative easing and zero interest rates they don't fix this. It's just life support. So we still have the ongoing problems that need fixing there. And I still think an awful lot of people are going to be turning to gold and silver long term. And of course, bottom line, this is where Asia tends to want to put its savings. And I think for Western investors, be it in North America or Western Europe, who are anxious about losing out, relatively speaking, on standard of living over the next 10 and 20 years, I think it makes sense to look at where the emerging economies and where tomorrow's powerhouses, what's the first thing they buy as a savings vehicle.
Adrian, for folks who are curious about what you do, tell us a little bit about how Bullion Vault works.
Well, BullionVault is an online gold and silver exchange, physical bullion. It's vaulted in your choice of London, New York, Zurich, and now Singapore. All the gold and silver is held in the form of large market-accredited good delivery bars. You're basically getting the finest quality gold. It's all warranted by the market, so the integrity is guaranteed on that. And you can buy and sell in live, real-time, online. You set your own price in open competition. We're big believers in free markets, and our customers can buy and sell online for 0.5% dealing commission, which is the lowest anywhere as far as we're aware. We've now got about 47,500 users worldwide. About 89-90% of our customer base is Western Europe and North America. And basically that's it, Phil. I mean, we're a very straightforward business. Our customers own their gold and silver outright. It belongs to them. It's their property. They're not exposed to our balance sheet in any way, and nor are we exposed to them. There's no credit, no leverage, no shorting. It's just physical gold and silver that you can buy, own, and sell.
Adrian Ash runs the research desk at BullionVault, the world's largest online investment gold service. He's online at BullionVault.com. Good place to visit. Hey, Adrian, thanks for this.
Thanks very much, Phil. It's good to speak with you again.
This Week in Money is archived online at TalkDigitalNetwork.com.
Jack Crooks is president of Black Swan Capital. He's a currency trader and investment advisor. He publishes Black Swan Currency Currents. It's a free global macro and market newsletter, and you can find him online at blackswantrading.com. Hey, Jack, it's always good to have you on This Week in Money.
It's always great to be with you. Thanks, Phil.
Jack, big question dominating the Forex markets this week. Will the Federal Reserve scale back QE? Fed policymakers continuing to hint that's going to happen in the next few months. Meanwhile, a lot of talk about currency wars everywhere. What's going on in the world of currencies?
That's an easy question. The funny thing was this week, this idea of them scaling back a bit on taking away some of this liquidity from the Fed seems to be the excuse for the big dollar hit yesterday. I mean, we've seen a lot of volatility for the last several days, and yesterday we saw a huge hit against the U.S. dollar. Today's jobs numbers, of course, suggest that the U.S. isn't falling apart again and is okay going forward. And just looking at the reaction in the U.S. bond market, that got hit very hard. Yields are up, long-term yields are up. So I think that idea of them not scaling back as much is kind of being washed out of the market a bit today, out of the currency markets at least, based on the price action. So we've seen a lot of volatility lately, but in general, I do think the long-term trend of the dollar is still intact. But we've seen a pretty aggressive corrective rally in the European currencies. But it's interesting, we see a big sell-off in the commodity currencies continue, and Australian dollar specifically getting hit very, very hard. New Zealand starting to follow. And the yen is kind of doing its own thing.
Jack, one of the things you told me last time we talked was that the U.S. dollar could positively surprise us in 2013, and we sure had a good week this week. Is it pretty much falling into the way you thought it would?
It is. It very much is, and I think one of the reasons, or two reasons I said that is I thought that the yield differentials, which are important in currency investing, the higher the relative yield differential in favor of a currency, the more hot money flow you get. So the yield differentials have been improving, the market yield differentials for the U.S. dollar relative to the other currencies as U.S. growth ticks up on a relative basis. And because of that growth in the U.S. and because of some of the foreign direct investment we see coming in and money moving back from offshore manufacturing money back into the U.S., we're seeing foreign direct investment into the U.S. despite all its other warts. And those are two generally positive factors for our currency on a intermediate to longer term basis, and that seems to still be playing out, and the dollar is moving along with those two factors.
Jack, for folks who missed the news earlier, the U.S. adding 175,000 jobs in May, the jobless rate rising very slightly, and of course everybody now thinking the Fed's going to start scaling back its monetary stimulus. That's what everybody's talking about this week.
It is, and as you said, it was kind of the driver of the currency markets yesterday and today to a large degree. The jobs numbers were better than expected, but they were by no means great, that's for sure. But, as we've talked about many times before, Phil, this whole currency investing game is quite perverse. It's a very relative game, and we can be bad here, but if we're better than other places, which we continue to be, the dollar tends to benefit.
Yeah, perverse is it's a great way to phrase it. Here's an interesting quote from Bill Gross, the bond king. He says low interest rate policies and those ongoing bond buying programs simply aren't working. What's your take on that?
Yeah, I think that's absolutely true. I mean, we see the relative amount of money and amount of debt added into not only the U.S. but the global economy by many of the central banks and even the fiscal side. And yet, what's happened is all this money and liquidity has bid up financial assets, stocks and bonds, of course. But the real economy, that place where we all work and live, really hasn't rebounded much at all. And in fact, it's deteriorating throughout Europe. And one could say, as we just talked about with the job market today, the job market in the U.S., when you look at the participation rate, has actually gotten a bit worse. So all this money is definitely not doing much for the real economy, but it is juicing those that live in the financial world.
Jack Crooks from BlackSwanTrading.com on This Week in Money. Let's visit the Eurozone and the single currency named, strangely enough, Jack, the euro. What a great idea, huh?
Yeah.
It's falling to $1.32 U.S. after hitting a 4-week high against the dollar this week. But you're warning that the euro could hit a ceiling anytime soon.
I do. I think the rally we've seen in the euro, again, is just a little bit of a technical rally in here and some of this idea of the U.S. potentially slowing. But even yesterday, the European Central Bank met, and chief of the ECB is Mario Draghi. He decided to leave rates on hold. I think some people were expecting a little more dovish view from him. But what's also interesting is the fact that he didn't cut interest rates at a time when we're still seeing deterioration in the European economy. German industrial orders were negative for April, worse than expected. So we're even seeing the core of Germany start to get a little bit in trouble. And I think Draghi's trying to make the point implicitly that he's probably done as much as he can from a monetary standpoint. There's still a real structural problem in the Eurozone that really is out of the hands of the ECB. So it's kind of funny because the euro bounced on the fact he didn't cut interest rates, but in the background, the economy continues to deteriorate. So we do think that the euro rally here could be close to over, and it's a great place to sell it. Even if you're wrong, we still think this level, we look back a month or so, we're going to say that was a gift selling the euro here.
Yeah, here's Mario Draghi in the news this week saying Europe's economy set for a recovery in the second half.
Yeah, on one side of his mouth he says that, and then the same day he downgrades Eurozone growth. So which is it? And the reality is there's still problems in the periphery. The pressure on Spain is tremendous. Italy, ditto, with unemployment rates rising. And a little-known fact, Finland just announced that they've slipped into a triple-dip recession. So there's still trouble on the horizon. And if Germany's, if the core of Germany, which, is really driven by industrial production and export growth, really starts to fade, then I think we could be revisiting another crisis, despite what Mr. Draghi says.
Great quote in the latest Black Swan Currency Currents, Jack, from David Owens of Jefferies Fixed Income. The ECB seems to have given up. It's as if they've decided there's not much more they can do, and they'll simply allow events to run their course.
Yeah, and that just goes to kind of what I've been saying. It was a great quote, and I think it's very insightful. Draghi has warned in several of these meetings. We usually listen to them live on the Reuters screen and watch him. And he's alluded to, and he's running out of patience with the politicos in Europe. And he said again and again, the European Central Bank can only do so much. These are structural problems that go to labor markets and everything else. It's kind of out of his hands. And I think he's close to making that point, or may have made it implicitly yesterday. And we'll have to see how this plays out. And I don't think it's going to be good because we still haven't seen any real great cooperation on the major issues. And the major issue for the Eurozone really is Germany. If Germany doesn't stimulate its domestic economy in terms of getting its consumers to spend and start to buy goods from those periphery countries, this thing's going to continue to be in trouble.
Let's take a look at the British pound sterling, Jack, posting sharp gains this week to $1.50 U.S. Bank of England did not change its key interest rate, and they maintained their QE at an unbelievable number here, £375 billion.
Yeah, the pound has staged a much stronger rally this week than we expected. And I think part of it was the fact that the economic numbers in the UK have been surprisingly positive. This week, good numbers on trade, good numbers on manufacturing services and housing prices continuing to rise faster than expected. Those are all good things, but, the longer-term problem that we have with the pound is, most of its export goes to the Eurozone, and lately a lot of its growth in exports have gone to China, and China is still really in a kind of a slowing down mode, so we don't think this positive boost is going to last for the pound. And with your ex-guy coming in, Mr. Carney, head of the Bank of Canada, starting July 1st at the Bank of England, has already signaled that he's going to probably loosen monetary policy even more with some non-standard monetary policy initiatives. So we do expect the pound to weaken going forward on a longer-term basis relative to the dollar, just because of the yield differentials we think are going to start to favor the dollar in a much bigger way.
Here's some more news from the guys at PIMCO. They've got an opinion on just about everything, it would seem, on CNBC this morning. Currency war could heat up when Carney joins the Bank of England.
Yeah, there's, PIMCO is out in front on this in terms of suggesting for some reason, and maybe I missed Mr. Carney saying this, but they expect a 15%, him to attempted to devalue the British pound by 15%.
Wow.
I'm not sure where that number comes from, and this is why they imply that it could be a currency war. We'll have to see.
Got to scratch your head, because here's another report here from TD Securities saying the pound is undervalued against the euro.
And I think that's true, and that's where the game you get into when you start looking at these currencies against one another. I'm speaking about the pound in favor of the dollar, but relative to the euro, I agree. I think the pound is undervalued against the euro, and I think, if somebody wants to just play those two currencies, the play would be, short the euro-pound cross, meaning expecting the pound to appreciate against the euro. We're in agreement there.
Let's visit lovely, scenic Switzerland. The Swiss currency, the franc, falling 2.5% against the dollar, almost 1.5% against the euro in May. What's going on with the franc?
Yeah, it's fascinating what's going on there. The Bank of the Central Bank of Switzerland, a while back pegged the franc to the euro because of the relative competitiveness and deflation that they were getting. So they pegged it to the euro at 120, and it's gotten weaker since relative to the euro. And there's another case where I think the franc is undervalued relative to the euro. But they've made it very clear they're going to maintain this peg, and they may even increase the rate in terms of trying to weaken their own currency more. The question becomes, and why this is a very interesting game, is if the euro hits another crisis, will the Swiss National Bank actually have enough money to maintain the peg? So that's a very interesting play that people are kind of watching for in the currency markets should the single currency get in trouble again.
Jack Crooks from BlackSwanTrading.com, our guest here on This Week of Money. Let's hop over to Asia. The yen, U.S. dollar gaining on the yen after Finance Minister Taro Aso says he won't intervene to push the yen back down, at least for the next little while. And the Wall Street Journal saying, is there a currency war? Is Japan starting a currency war here? What's going on?
Yeah, just maybe start with that whole currency war idea thing. We've written about this a couple times. The idea that Japan is sparking a currency war is really kind of funny, because if you go back and look at Japanese currency, before the credit crunch, the yen was trading around 124 to the dollar. It's now trading at 97 to the dollar. The point is that during the credit crunch, the Japanese took the brunt of the currency appreciation because of the credit crunch. They're not even back to where they were. And to say that what they're doing is a currency war is kind of silly in retrospect when you look at the relative volatility, that we've seen over the years and where the Japanese yen has come from. That said, there's no doubt they'd be happy with a weaker currency because they're trying to create some inflation. Funny thing is, we've had a pretty powerful correction or strengthening of the Japanese yen over the last several weeks. And, so it kind of goes to show that governments can't completely control their currencies. And the idea of a currency war amidst what's referred to as a floating rate currency system. Currencies float against one another relative to market supply and demand. Where in the old days, currencies were pegged and the government could literally just devalue their currencies, the official values. They cannot do that anymore, the major currencies of the world. So the idea of a currency war is somewhat odd. There's no doubt there's a stimulus war going on around the world, central bank stimulus war, and Japan is winning that, and as a result, it's been weakening its currency in the process over the last few months.
Here's a startling number. The Japanese exchange rate's fallen 20% against the dollar and the euro in the last 6 months.
That's right. It's been a pretty quick move. It was straight up at one time, but that's changed, and we're starting to see some backing and filling and corrections. But as I said, think about where it went from middle 2007, 2008 area from 124 all the way down to 75. Yeah. And as I said, the Japanese took the brunt of that. So I think they're just they're mid-range compared to where they were then, and I expect them to get back there at least.
Star of the show in Asia, obviously the Chinese currency, the yuan, has risen 1.6% just since the beginning of the year. Asia's best performance, Jack.
Yeah, we're seeing some hot money flow and back into China again. Some stimulus, housing prices, real estate prices are moving up again. The question is, can it be sustained? Net, it's a good thing because the emerging markets have been seeing money flowing out of there, and China's kind of the driver of that. So we'll just have to see how long that is maintained. There's no doubt, we're not going to see much more of a movement, I don't think, in the Chinese currency, given the way they control it, i.e. that, the Chinese government controls it. So it's probably a net good thing at the moment. But the reality is if we see a liquidity problem developing in China, and we've already seen the emerging market bonds this week get hit pretty hard, we have to be very careful of another crisis flowing from the emerging markets into the center. So China's currency is a good indication of that, but really underneath the surface is just tracking that hot money flow into China.
Jack, China's central bank governor in the news this week saying China will not compete for currency depreciation. He's not interested in getting involved in a currency war. Is that just talk, or is that official policy?
Oh, yeah, the Chinese never want to weaken their currency at all. No, I'm sure that's just that's all true. It's coming from from China. I'm just kidding, because we know over the years that the Chinese currency is, on a relative basis, given the growth and the wealth in China, they've kept a big cap on their currency. The thing is, given where we are in the global economy being still fragile, I don't think any of the major Western governments want to ignite a currency war with China and put up trade barriers and things. But in the background, people are still very unhappy with the way China keeps suppressing their currency value.
Jack Crooks from BlackSwanTrading.com, our guest here on This Week in Money. Let's look at the dolls, the commodity dollar, starting with the Canadian dollar. After falling almost 2% in the last month, it gains the most in almost a year against the greenback, up to 98 cents U.S. today.
Nice rally this week in the Canadian dollar. Great jobs numbers there, I think, in Canada today. Construction, I guess it was. Mm-hmm. And you look at the Canadian dollar relative to Aussie and New Zealand, and you wouldn't even know that they're commodity currencies. Canada has been, quite strong, as I said, this week. And Aussie and New Zealand, and they usually move as a pack, are moving the other way. Even right now, we have, the Canadian dollar's up against the U.S. dollar. Aussie's down almost over 1%, and New Zealand dollar's like 1.75% today down. So we've seen a huge divergence taking place between Canada and the rest of the commodities pack. So it just it kind of goes, I think, to the point that Canada is a little closer to the U.S. in the relative growth, and Australia and New Zealand are seeing the real hit finally from the breakdown in the commodities basket. So it's a very interesting dichotomy, and I've said for a while that I thought Australian dollar was way overvalued relative to Canadian dollar. Unfortunately, I didn't stay with the trade, but I do think from a Canadian standpoint that this will continue. I think on a relative basis, even if Canadian dollar were to start to depreciate against the U.S. dollar, it will do better than the other commodity currencies. Interesting technical uptick for the loonie this week, Jack, crossing the 200-day moving average. Yeah, it's been just relatively strong, and I wish I had an explanation for why it continues to move in its own basket over many, many years. We've seen it do this at times, and I've always said that's why we call it the loonie. It's hard to peg because it's sometimes it just operates in its own orbit, and it's doing that at the moment.
You mentioned Mark Carney earlier, Jack. A new Bank of Canada Governor Stephen Poloz says rates here are going to rise as the economy grows. He wouldn't say whether the Canadian dollar is overvalued. What do you think?
I don't think, again, it depends on who you value it against, but against the U.S. dollar, I don't think it's overvalued. That's for sure, especially where it's come from. And given the relative, performance of the Canadian economy, I especially don't think it's overvalued. I think ultimately, if the dollar starts back into its rally mode, it will weaken. But I don't see it, just being, getting hit in the degree that we'll see Aussie and New Zealand, which I think still has very big premiums in them.
Yeah, let's talk about the Aussie dollar for a second. Diving below 95 cents U.S. Everybody down there are worried about the same thing that worldwide investors worry about, and that is, of course, that the Fed may slow down the stimulus.
Yeah, that, and they're also, and I think that there's a growing consensus among a lot of the currency guys that the Central Bank of Australia, it's called the Reserve Bank of Australia, is going to have to cut rates pretty aggressively going forward. They're starting to see the hit that they've already, from their general economy with the currency so high, which hasn't, from a manufacturing standpoint, hasn't done so well. What I was going to say was they're finally starting to see a hit on the jobs market from some of the slowdown in mining because of the slowing relative demand from China and the break in commodities prices across the board, metals prices across the board. So we think Aussie, even though it's been hit very hard, we've been looking for some type of bounce to get short again, but we do think it has a lot further to go.
Our final calm down, the New Zealand dollar, the Kiwi rising to 79 cents U.S., the slowdown in Australia, of course, and of course that speculation that the Fed is going to stuff the rabbit back in the hat. That's worrying them down there too.
It is, and they've even explicitly come out there, their central bank chief has said he wants a lower currency and they'll do whatever they can to push it down. So you have a couple different things in play there. So I do think it'll continue to move in conjunction with the Aussie.
Jack Crooks is president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at blackswantrading.com. Jack, thanks for the trip around the worldwide currencies. It was fun.
That was fun. Thanks, Phil. I appreciate it.
Thanks to our guests, Adrian Ash and Jack Crooks. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.